Puccinelli, and Nolan and I had met because of the infinite banking that Nolan's involved with. And what I do is I create channel partnerships, strategic partnerships, where I'm connecting a lot of people with oil and gas clients. I'm sorry, infinite banking clients with oil and gas private investments. So my background is in sales and marketing, and I work with a partner that I've known for 15 years, who's the CEO of Lono Capital, which is the lending or the finance raising arm of a private oil and gas company. And Nolan and I had met. He flew out and saw the field, and it was a great experience because that's kind of what we're here for. And I just talking about all the different aspects of the industry from a high level. I don't really dive into the deep finances, which my partner Bill, he's been in the financial sector for 35 plus years, 40 years. So that's really his wheelhouse. My wheelhouse is more of the educational side, the sales and marketing side, and the partnership side.
Yeah, so basically what I'm actually Scott called me this afternoon. We were just discussing about, just like when we went out there, Zane and I went out there just under a month ago and walked their site. They have a couple of leases out there. And I wanted to invite Scott on tonight, of course, not just to describe really just the oil and gas business in general, but how similar oil and gas investing is to commercial real estate investing, but most importantly, the depreciation deduction that we talk about all the time. And I thought it would be good just to hear a different, like a similar perspective, but a different perspective and how the tax laws incentivize investment. And so it's so funny how maybe when a lot of people, maybe whether they agree or not, I think the law is an incentive structure, not based upon the government trying to penalize you. It's saying, hey, we need more of this, so let's subsidize it. Let's let them deduct things. Let's let them utilize all of the deduction costs that they would get otherwise. And Scott actually reached out to me maybe again 2 months or so ago, and we just got together and we're like, man, there's a lot of synergy between our real estate investment and our again our the oil and gas. So if you don't mind, Scott, I mean, does anybody have a quick question? I mean, we don't have a ton of people on tonight, I guess. A lot of, like I said, a lot of Autobots, I guess, or whatever. But does anybody have any quick questions for Scott? I'd like him to kind of jump in and we can kind of go over some. I've got a few more questions for him as people are trying to understand, but talking about, I think the main juice tonight is about the misconceptions of investing in oil and gas or even commercial real estate, but then most importantly, the massive benefits of depreciation. So does anybody have any like quick thoughts before kind of Scott jumps in? Awesome. Go for it, Scott. Give us
Nope.
your or Richard, you got something?
No, I was just gonna say no. I'm good. I'm anxious to hear more.
Cool, brother. Awesome. Yeah, Scott, go ahead, man. Give us kind of just like you the what is it? What are we talking about? That kind of thing.
The funny thing is it's probably the best place to start, especially when you're talking to a group that's familiar with real estate at any level, because real estate investors that's kind of like the breeding ground where a lot of people come from for oil and gas. I mean, the investors that invest with us typically have three main categories, which are equities. Virtually all of them have real estate, and then they have oil and gas. And the reason being is it's the ultimate hedge. Plus, it provides massive returns. And when I say it's the ultimate hedge, I mean it's energy. It's the driver of the global economy. No matter what side of the aisle you're on, it really doesn't matter. I mean, at the end of the day, there's a reality, and reality is we have to produce all this stuff that we have. And oil touches everything. It touches the shirt, it touches this camera, everything. Everything was produced with oil. So they certainly don't need less of it. It's on its decline is supposed to be not even peaked until I think McKinsey put it at another 5 or 6 years from now, and they keep pushing that down the road. I think 4 or 5 years ago, they said 5 or 6 years ago, and then they keep pushing it down. So that's when the global oil demand is supposed to start declining, and that's like a 50-year decline. That keeps getting pushed out. So oil is a huge necessity in everybody's portfolio. And the reason the government has that tax law is precisely that. It doesn't matter what side of the aisle you're on, at all levels, within all parties, they fully understand the absolute necessity of oil. And when you look at it, and I can put it in the comments after I stop talking, of the two main tax laws. One is for the upfront investment, which can be written off up to 100%, which it used to be historically 85. And Trump, when he was president in his first presidency in 2017, he raised that for the intangible drilling cost deductions up to 100%. And it's certainly not going to get reversed now. And because I think this was the last year where it was coming up for a vote. So that should continue. And the reason that they do that is because they want the investment. And you can write off against all forms of income your upfront investment. So if you had a $100,000 investment for numerical purposes, $100,000 can be written off against any type of income, passive income, W-2 income. It doesn't matter. And when you look at our tax law, it's very ironic, because anybody who's ever read any of it or had a conversation with a CPA, your real estate investors, you certainly know it's a complex tax code. The oil and gas, the two codes with the intangible drilling cost and the depletion allowance, which is that you get 15% tax free off of your producing oil when it produces oil. If you're under 3,000 barrels, over 3,000 barrels, you're commercial, you don't get that deduction. But in private investments like this, joint partnerships, that's usually always the case, is under 3,000 barrels per day. But those two codes are incredibly simplistic. People don't believe us when we tell them, yeah, you get 100% same year against all forms of income. They just don't believe it. And they said, well, just look it up. It's actually very, very simplistic. It's like 4 or 5 lines describing precisely what I just said. It's that they made it that simple. From our incredibly complex tax code, they made it that simple. And the reason being is we need oil. And we are the largest oil producer in the world, which is another thing a lot of people don't know. It's not Saudi Arabia. It's America. Oil and certainly natural gas, by far natural gas. But with crude, it's us as well. We have a ton of it. And we're probably going to go back to being a net exporter now that the presidency has been decided and Trump's going to be in office. There's going to be immediate changes, in my opinion, to the oil and gas infrastructure. I think pipelines are going to come back on. There's leases on federal land are going to be opened back up. So it's going to be an initial push, because it'll drive down inflation almost instantly.
So
that's the tax benefits of it.
let me ask you this question, Scott, that I think a lot of people have, because again, guys, like, I want to give you guys a well-rounded idea of how there's another way to use the tax laws to your incentive or to your advantage. What are a lot of misconceptions about oil and gas that most people, because especially when I got some stuff in West Texas and North Dakota, why do most people think of oil and gas as risky, number one? And then how do what you guys do decrease that risk, if that makes sense?
Yeah, so there's all different kinds of investments, and there's all different kinds of oil and gas. So a lot of people immediately think of Deepwater Horizon, massive rigs in the Gulf. That's not a private investment. That's a Fortune 100 company. You can't invest in that unless you buy BP stock. They also think of some of the bigger projects that are up in North Dakota or in Texas, where I'm from, down in the Permian Basin down south. You can do some of those from private investment, but they're big investments, because those are much larger rigs. They're much more complex rigs. They're horizontal drills. They're new drills, so it's exploration, and they could be 15,000 feet horizontally and then another 10,000 feet vertically. I mean, that's a massive, digging through shale. which is that's like your granite countertop, right? Hard rock. Now, that's inherently riskier than something which could be like what you saw, which is up in the panhandle, the Amarillo area of Texas, North Texas. It's a much softer ground, and that's a shallow well. Those are 3,000, 3,500 vertical wells. That's like digging in a sandbox versus underwater exploration, right? So between the two, obviously the bigger one is going to be dramatically riskier. That doesn't make it a bad investment. It just makes it a much riskier investment for a different type of investor. Because, hey, if it hits, it will produce, from a return perspective, it could produce 30, 40 times more. But that's the risk. So is that the right investment for you? Only you can decide that. We don't do very much of that, if any at all. What we do, what you saw, we like to call ourselves, we're the doubles and singles, right? There's nothing wrong with Moneyball. The A's had the lowest payroll and they produced the most from it. That's finance. I mean, what are you paying for it? What's the risk? And what do you get? The doubles and singles get you on. And what Nolan saw, that investment it's a reentry. So these wells have been around for could be 100 years, and they've had new equipment put on them and whatnot, but they could have been turned off for 5, 10, who knows? It could just be a mom and pop organization that bought them 20 years ago, 30 years ago, and just never did any work. They pumped oil and they got what they got and they were totally happy with it. Or they could just be in the family forever. Nobody did anything with them. And it's really, they don't have the money to go in and raise several $1 millions to get a bunch of wells brought back online with acid treatments and different types of fracking and things of that nature. It's too big for the mom and pop or for the family owned mineral rights person to do that themselves. But it's also too small. Right, that company that we talked about, Nolan, that was in that area that has 3,000 wells. Their company's name is Large. That's the actual name of the company, and they're not gonna do what we were doing with a 20 well field. It's just too small for them. Now, they may come in and buy it once they realize what's coming out of it after we do the work. That's part of the business, but they're certainly not going to put their R&D into it. They're not going to put their people on it. So there's this kind of middle, which is very similar to real estate, right? I've got a lot of friends that got into multifamily, they got into commercial, where in Dallas specifically, the whole downtown uptown got built up, and these companies come in and they level these old apartment complexes and put up these monstrosities, and they spend a fortune, an absolute fortune, and the rent is going through the roof. There's a limit to that before it becomes financially unstable, where the people that live there can't afford to live there. Well, I have friends that go in and they just go right on the edge, right where these developers stop developing. They go, a few blocks down, and which is still a great area, and they find multifamily units where they don't tear them down. They're good enough just to be redone, and they have a built-in capacity that's, the family might have owned that business, a company might own that business or unit for 25 years, and it's at 50% capacity, and they know they spend X, which is nowhere near knock down and rebuild, and they can increase that 50% to 75. They'll be making a very healthy return. And there's nothing guaranteed to life, but that's pretty virtually guaranteed. I mean, it's right next to the nice market because of all the other developers and what they did. It's the same thing in oil and gas. That's what we did, is just look for those doubles and singles that will produce still. I mean, they could be producing 2, 3 times your investment.
Yeah, let me mention this because again, guys, this is candidly, this is exclusive to our collective. We're not like offering. This is not an offer. This is just like y'all are getting a chance to potentially get a piece of this if you wanted to. Of course, I'll introduce you to Scott. You guys get on your own calls with him or whatever. But if I can distill this down to someone who is maybe like you when it comes to this, let me explain how Scott is talking about this. He's talking about the Deepwater Horizon, which is out in the Gulf of Mexico. They went and drilled down into the ground, and that thing is producing 60,000 barrels of oil per day. Ballpark, Scott, am I around that number?
It's actually a little bit more. That's what it was losing when it broke.
So ballpark, okay, so call it 60, 65,000 barrels a day, which is insane because if oil is trading at 65 to $85 a barrel, It's a very profitable day. And so what Scott and Bill have in Amarillo, Texas, or that surrounding county right there, is they own leases, which are basically the mineral rights that they have purchased the lease from previous families and owners that Canley just did not have the capital to upkeep the facility or upkeep the machinery. So what they did is they go in, and that's where capital gets injected. It's not so much about anything other just getting oil producing again. And these pump jacks are basically fracking anywhere from 150 to 250 barrels a day. Am I about right?
The field, yeah. So each well can
The
do
field.
anything from, for it could be 5 to 15, 20 barrels a day per well, right? And
Okay.
you can hit dry holes. I mean, you typically don't anymore, but I mean, it happens. So when you put together a larger field, which has 20, 30 wells in it, the safety's in numbers. Even if one of them's dry, one of them might be overproducing. So
And just to clarify what he's saying, and like at least when I was down there with Bill and Scott, it's you're not going to be you don't have bases loaded, you're not hitting a grand slam like Jose Canseco, but you are on base every single at bat like Ichiro. If you really want to get into baseball phrasing, like every single one of these guys that are going on because they have already drilled these wells back in the 1930s and 40s, all they have to do is just bring these guys back to life, and then they're already reproducing it. They've already been proven wells. So, but to go a step further again, a couple of differences that I've discovered that Scott and I were talking about in the suburban as we were driving back. There's two big differences that I've discovered in oil and gas and commercial real estate. Probably the biggest is, again, you can call it risky or not. It just depends upon your appetite for risk. Talking about drilling down vertically and then drilling horizontally, there's a lot more cost to drilling. You have a lot more upside, which is one thing. But also a second piece, which is not right or wrong, is oil and gas is only truly it's an equity business, it's a cash business. Where in commercial real estate, you have real estate as the collateral that you can have the bank lend money on. So for an example, and Scott, we can go into this with just like general numbers. If you have $100,000, you could put it into this oil and gas deal that Scott and that Scott has, and it could be awesome, great returns, awesome. But you got 100 grand in that deal. You get the depreciation, you get the awesome upside of cash flow. With commercial real estate, you have the same 100,000. You can go purchase a $500,000 building and get depreciation on 500,000. But also because of the step down in basis, the depreciation is really about the same. It's the nature of the collateral in which you're using the money for. So the bank is leveraging the collateral, which is your piece of real estate. And then in this case, you have the equity that's invested in the oil and gas. And it just depends upon your risk appetite. Am I crazy by giving that quick little
yeah,
synopsis?
yeah, and the risk appetite really comes back to what project is it? Is it a new exploration, or is it a reentry? Is it a vertical, or is it a horizontal? So like what we're doing, we wanted to create something that had the real upside of oil and gas. And when you talk about the upside is significant. That's where if you Google around on YouTube and whatnot, people will outright say like the returns they can be and now usually are astronomical. And it's a private investment, which is why I mean, you don't hear about it that much because it's not like you can just get involved with it like real estate. You have to really know somebody that does that. And when you do it, you got to also know what you're investing in. And that's the huge kind of gap. So, the risk for us, we wanted to mitigate as much as humanly possible. So we look for reentries versus new exploration, and with vertical wells versus horizontal, because what you saw and what you're talking about is they're pulling the well bore out from the 3,000-foot hole. They're basically, for a layman's, just fixing it with acid, pouring acid on the outside, on the inside, down the well bore hole, and it goes back in. And then it's clean. Pumps a lot more oil. So if it was doing 2, 4 barrels a day. Now it might be doing 8 to 15. And that's really where you get the same type of return from oil and gas because the commodity price is a commodity price. The difference is just the volume. You're obviously going to get a lot more volume out of a horizontal well, but that's where the tremendous risk is. So, with the doubles and singles, it's how do you mitigate as much as possible? And when you do that, that's really where the infinite banking came in. Because yes, a lot of our investors are cash investors, but what we also find is that the people that buy into infinite banking and have those resources at their disposal, when you start talking about leverage and cash on cash, a pretty solid return. Most people would think 32% cash on cash is a great return. In oil and gas, it's okay. I mean, it's all right. It can be much, much better. I mean, it can be several 100% in the first year. When you do that with leveraged policy loans, it's astronomical what that same percentile turns into. And that's what we found working with infinite banking partners is that because we've mitigated the risk a lot with the oil and gas side of it, just doing reentries, going in shallower fields, and going after those doubles and singles, people are more apt to leverage their policies to do it because the return is so much better from a cash on cash perspective. So you can do it either way, all cash, but that's where the infinite banking really came in play.
Yeah. And that's kind of how Scott and I got a chance to get to know each other. It was through, well, candidly, I'm doing the thing. I'm doing the infinite banking policy with Scott and those guys, and it's taking policy loans to invest in those deals. And that's kind of whether this is for you guys or not, I wanted to at least offer this opportunity, not from me, but to where you can get directly with Scott and see if this is free. Does anybody have questions, thoughts, or anything indifferent about that? I know this is like a little bit different than what we usually go over, but I thought that it's interesting as a way that somebody's wanting to get a return on their money. Let's see if you guys have any ideas or any thoughts or opinions.
Yeah, I have a question.
Mhm.
So, Scott, good to see you again, my man.
Good to see you again.
So I was just curious if you could kind of explain to everybody your role with Bill and the story about how you guys got together and how you started doing this whole oil thing. I would just love to hear it.
Yeah, so I met Bill about 15 years ago. I was in the Air Force. He was a naval officer, so we had that connection. He had just moved to Dallas. It was during the economic collapse, and he left Merrill Lynch and came down here because he knew a guy that was involved in the oil and gas business. And really, he was, his expertise was raising capital and for these types of projects. And he went to work for him, who I actually happened to know because I worked for CBS at the time, and I was doing sales and marketing for CBS. And I worked heavily in the financial sector. So I worked with a lot of wealth managers, people involved with annuities, real estate. I actually got that job because my manager was good friends with Robert Kiyosaki. Obviously being in real estate, who Robert is. My uncle is his attorney. That's how I kind of worked into this. And Robert he did some shows for these guys that Bill used to work for because Robert's a huge oil guy. Actually, he's a perfect example. He has lots of oil and gas investments, as well as, I mean, who knows how many thousands of units he has now. But that's how I met Bill, and Bill worked for that company for quite a while. I mean, he basically was running the entire financial and sales side of that company. With the president was an engineer, and like every entrepreneur, he just said, "I can do this bigger and better and safer," which is exactly what he's doing. And he went out on his own, and over the past few years, has been acquiring these fields and is putting his own money into them, going out, making sure that they're going to be the safer type of field that he really saw the value in, not just from an investment standpoint, but from his own business standpoint. I mean, if this helps mitigate the risk, from raising capital, it's very expensive and it's very difficult, and it's much easier when it works because you can go back to the same people and guess what they do? they reinvest with you
Mhm.
over and over and over again. There's no reason not to. So simply by restructuring the investment offerings, which all it's another thing that he does that a lot don't. And this is where kind of the bad name for oil and gas comes in, is that years ago there used to be all kinds of scams. That's really, it's been cracked down on tremendously. I wouldn't say there's scams as much anymore as people that just don't tell the entire truth. Like we ran into somebody that was talking to, happened to be talking, they were from Minnesota, but happened to be talking to somebody just down the road from Bill's company. And they're saying, the safety of horizontal drills. I mean, there's ways to make horizontal drills a safer investment, but at the end of the day, you're exploring and you're drilling through granite and shale and rock and all that. It has inherent risks. And nobody should ever say it's safe. There's ways to make things safe, but nothing is. I mean, hey, Lehman Brothers and Bear Stearns collapsed. Arthur Andersen collapsed. Nothing is guaranteed. So, Bill and I connected about a year ago, and he started telling me this. I go, I always wondered why the last guy he worked for never did that. He goes, yeah, he loved swinging for the fences. It was an ego thing. He was, no offense to any engineers on here. He was an engineer. He would do things that would, I think he burned once like 5 million of his own money chasing a re-entry. I mean, there's no reason, but financially, he'll never make his money back ever. There's no reason for any of that. So there's just business practices that go along with who you invest with. That is no different in oil and gas than it is with real estate, than it is with software. That's really about doing your due diligence on who's running the company, right? Look at GE after Jack Welch left. I mean, it just cratered. So those are things that I loved about Bill, and that's why I just kind of got involved, because my background is more on the sales side, and I know a lot about this industry because I did so much work years and years and years ago, all the way up until today, with the finance sector, with the oil and gas sector, and being in Texas. It's everywhere. I mean, to us, it's, like, why don't people do this? I mean, they're crazy not to. It's like, well, outside of this state, it's very unknown. And it's very, I mean, in some areas it might be faux pas. And does somebody have a question? No. So that's how we met, and that's how this story came to be.
Cool. Thanks for that.
I do have a question. Can you guys hear me?
Mhm.
Good.
This is Richard. Did you say you're in Amarillo? Where'd you say you are?
I'm in Dallas. So the CEO, Bill, he and I are both in the Dallas Fort Worth area, Plano, if you know the area.
Yeah, I do. As a matter of fact, I've got clients in Texas, and I'm going to be in Amarillo, Lubbock, Midland, and Odessa next couple of months.
Oh,
So that's
okay.
all West Texas, as you were talking about. And so
Mhm.
maybe there's an opportunity for us to time it up and meet or whatever. But did you say that's where some of the
So the
pump
field
jacks
is
are? Some of the fields
yeah,
are?
it is. And that's where a lot of, so he's got multiple fields in that area. And it's actually, anybody watch Yellowstone?
Yeah,
Okay. They brought up Pampa, which shocked me.
that's right.
So,
I saw that last night or 2 nights ago, whenever that
so,
was.
so Pampa happens to be where the field is. I say Amarillo because everybody's heard of Amarillo and has a pretty decent idea where it is. Nobody knows where Pampa is, but that's where the actual field is. It's like 45 minutes outside of Amarillo.
I know when I was watching that, I told my wife, I know where Pampa is. I've been there. She goes, no, you haven't. I said, yes, I have.
I'm shocked that I'm talking to somebody that knows where Pampa, Texas is. I didn't know where it is. I've lived in Texas for 16 years. I had no idea where Pampa was until about 9 months ago.
Yeah. There's
Oddly
not a
enough,
whole lot in West Texas.
oddly
But I
enough, I
mean,
know where Pampa's at as well. I went to school in Snyder, if you know where Snyder's at.
yeah, yeah. Well, I mean, if you're up there, by all means, we get out there quite a bit, and we love showing people the field, and it's great for you to see it because Nolan says on that video, it's so much more digestible because you're not thinking of these 25, 35 story gigantic rigs. It's a pump jack that's, I don't know, what are they, about 15 feet, if
Yeah.
that.
Yeah, maybe.
That's it. That's all it is. And it sucks oil out of the ground like you wouldn't believe. And it works just fine.
It's
And
very underwhelming. It's a very
it's very
underwhelming
underwhelming.
experience, like not in a bad way, but in a way of you're like, Wow. I didn't know what I was going to expect, but I was like, huh, okay, well, there's 80 acres here. There's 20 pump jacks. They're all bringing oil up into the ground. I go look at this battery over here, and these guys come and pick it up.
Well,
Sounds,
and a lot of people
yep.
don't understand that you can invest $100,000. When you start to see these types of projects, it makes more sense. A lot of people have a misconception like, I need $1 million, $3 million to invest in a private oil project. You certainly can, but you don't have to. I mean, that way you would have to have a big project or your own project to invest that type of money. That would have to be something where you invested in an entire field yourself, or, a 15, $20 million horizontal project and you're one of the big investors. 100, 200, $300,000 is probably the sweet spot of where a lot of people start.
And you guys also said, I believe, that you gather most of your investment or lock it in around this time of year, right?
Oh
Where
yeah. Yeah.
everyone
This
get that
is the time
information.
where people look at what they made and they might get bonuses or what have you. And well, especially, I don't know if there's anybody that's older on this call, but there's a kind of a niche investment market for uh, IRA withdrawals. The mandatory age is 73. That's income. That's W-2 income. So people getting $100,000 mandatory withdrawal, that jacks their taxes across the board. So at the end of the year, this is when everybody comes in and just says, you know what, I have to pay X amount. For numerical purposes, if you're at the higher end of the tax bracket or even at the top, you write $100,000 check, that's 22, 25, 37% on your money when you write the check, just from the tax benefit.
Wow. And not to mention the returns from the
From
field.
the oil,
Yeah.
right? Yeah, that doesn't, so what, uh, that one kind of in the middle row on the conversion chart that was 32% cash on cash, that does not include the tax write-off for the upfront intangible drilling costs. And it also does not include the depletion allowance, which is when it starts producing. So let's say for numerical purposes, your investment creates $10,000 a month of cash flow. 1,500 of that is not taxable. So that's why real estate investors also love it, is that, the income that comes off the cash flow also has very good tax write-offs.
Let me ask you this, Scott. I know this sounds kind of a cliche question, but what questions are we not asking? Like when somebody is getting in or thinking about this or even trying to consider, of course, like I said earlier, guys, like if this is any interest to you guys, I'll of course just give just Scott's information. I'll send an introductory email to you guys. You guys can just talk because I'm not the expert, Scott is. But what kind of questions are people when they're getting started? What are they not asking? Because that's, like you said, what
So
it creates this high level of risk in their mind. But like, how can we like lower the risk in our mind?
yeah, so it's understanding the business and things like there's something called the lift cost. Now, lift costs are very different depending on where you are. When you're up in North Dakota, you're down in South Texas. These shale sites they're far from anything. And there's a tremendous cost in moving oil. So lift cost can be a significant percentile of what comes out. So you got to be sure when you're reading their projections that the lift costs are included. And with what you went out and saw, in Pampa, there's refineries everywhere. I mean, you could actually turn around from that first one we went to and look and see the Valero refinery. I mean, it's like 10 miles away.
Yeah.
So the costs are very low. The other thing is not only the lift costs, but the kind of the overall cost. Like, what does it cost you, Mr. Oilman, to get this oil out of the ground? That's also part of the money ball game, right? The
I
doubles, singles, right? Horizontal wells are very expensive not only to make, but to produce oil with. It can be $55 a barrel to get it out of the ground. Well, that's a great margin still if it's $65 a barrel. But if it goes down to 55, they'll turn it off, obviously. And what this field gets it out of the ground, I think it's 25 is the break even.
Okay.
So there's variables, and that's another thing is that as an oil and gas investment, this is a commodity investment. It, yeah, can it happen in real estate? Yes. Does it? Not anywhere near as much as it does in oil and gas. And it's been pretty constant for quite a while. You get into things with when the Saudis and OPEC like to start causing trouble, they'll overproduce until they bankrupt their own nations and then they stop. It's stuff like that that's involved in the business. It's very seldom, but it can happen. When, unfortunately, I mean, it's horrible, but when negative things happen, the price of oil goes up. When refineries go down, when hurricanes come in, when wars break out, oil always goes up. So that's another element, but it can go the other way. So, and I think it's important with this, just to preface that of where, we brought this up on that visit. Where did we think the price of oil would go? And is there a bad president that could be elected for oil and gas? And really the answer was no on both sides, because we thought it would go up a lot more had Kamala won. However, since Trump won, Trump is very unique. He knows full well where oil needs to be. He's a huge energy guy, huge. So he talked about it in his acceptance speech. He knows it's the driver of the global economy. He knows it's a powerhouse that backs America. He wants to make sure it sits around 60, 65 bucks a barrel. 65 is the absolute sweet spot for the American economy. Oil business makes tons and tons of money. Americans don't pay out the, what, for gasoline and everything else that it touches. So that's the sweet spot. He actually was in office when it was starting to get, that's back when OPEC was doing that. And they actually produced it so much that for a while, oil went negative. There was like a day where oil was like fried chicken, a bucket of KFC was more expensive. And he actually created some policy changes very quickly that brought it back up, and did some negotiations that brought it back up. And by the time he left office, I believe it was back up to like 50 bucks. So that happened very quickly from 0 to 50. I think it was in a matter of like 6 or 7 months. So that's very important to know, that you've got a president that understands this needs to be at a sweet spot. We don't want to overproduce it. We don't want to get into that element of driving the price down so low that, not really for companies our size, but for the bigger ones, they have to turn them off.
And what Scott's talking about, guys, too, is if you haven't seen it, I'll post the YouTube video. I've already posted it online, but I'll post it on school so y'all can see it, where we were out in the field with Bill and Scott for. I mean, it was great. It was. You can see everything. We're about as. I don't know if we can be more transparent. I mean, we're like.
Yeah, it was cool. They had the workover rig.
Like it was awesome. It was great.
And Scott, I have another question just for anybody else.
Yep.
So as far as the qualifications that somebody would need to meet as an investor, could you go over kind of like what somebody would need to, what kind of person or what kind of qualifications they would need to meet in order to actually invest with you guys?
Yeah, you need to be an accredited investor. You're probably familiar with that term. You need to make over $200,000 of income annually and have a net worth of $1 million, excluding your personal residence. So you meet those two criteria, you're an accredited investor, and you can become part of a joint partnership investment.
Okay.
Yeah, good question.
And like I said, guys, anybody that has questions about this, we just wanted to mix it up and just, I would say this is probably the first time we've done this where there's, talking about oil and gas, but it's just different. So if there's anybody else that has questions or thoughts on this, of course, I will introduce you to Scott and Bill, and we can always just chop it up and kind of go from there if you guys have any other thoughts.
Thank you for doing this, Nolan. This is really cool. Thanks.
My dog just shut up. Yeah, no, I enjoy this too, because I like the fact that I like talking to people that have experience in real estate, because they fully understand the power of the tax benefits. Uh, I think, and Nolan, you tell me, I think real estate has its benefits from taxes more with the long-term depreciation on the cash flow, whereas you get a massive hit up front with oil and gas. And you do have the depletion allowance, which is the 15% off. But where I think they really differ and where it's a tremendous addition to a portfolio is the fact that the returns they're extremely high, very high.
And I remember on the video that we made, you guys were saying a crazy number about the split between what you guys make in profit and what the
Yeah. Yeah. So that's another thing that going to Nolan's, what questions are we not asking? You need to ask companies, what is the split and do we own it? Because a lot of companies will do this, especially with reentry projects where they'll go out and it could be with somebody like us and they'll bring the investment in, but all they're giving the investor is the cash flow. They do not technically own the field in a joint partnership. Bill does not do that. As a joint partner, you own that field and it's a 90-10 split. So 90% of the investment goes to the investors, 10% goes to the company. And, let's say it's an acquisition, then you are part of that acquisition. You get because you own part of the field. If there was an acquisition and it wasn't where all you're doing is investing in, 2 or 3 different wells that you don't own the mineral rights to, then you don't. It's just turned off.
I see.
100%. Well, here's what I want to show that before we make a move. Let me just show kind of what Scott was talking about when he was mentioning just the returns with how Scott and I kind of got together. You guys might have already seen this before, just talking about the different ways to buy a piece of real estate. This is very similar with oil and gas. So imagine the same thing over on this sideline with an infinite banking policy. You're essentially taking a policy loan to invest in that oil deal. And imagine if there was no debt service, and imagine the cash on cash was a lot higher. What ends up happening is you have, like Scott and I were mentioning, hundreds of percent, thousands of percent return on cash because you're using the insurance company's money to invest. And that's kind of, like I said, like Scott mentioned it when we first got started. He's like, hey, I wanted to reach out to you because I've seen that you're in an infinite banking, you're in investment. This is a great way for your investors and your policyholders and your clients to reduce their risk and get a higher rate of return on their cash by using the insurance company's money to invest. So this is not like a one all be all, but when you notice the difference of just cash on cash return by just using the insurance company's money to do the deal versus your own, it truly, and you're the one that gets all the tax benefits, not the insurance company. That's when I feel like it can really turn into something cool. Scott, do you have like one more like final thought on that?
No, I mean that's exactly why I reached out. And I think the big difference is that when you pair it with an oil and gas company that really creates the singles and doubles and just goes after lower risk investments, like we said on that thing, to do that type of leverage, you really want to be as safe as you can possibly be. And the likelihood of hitting 20 dry holes on a 20 well field is, I mean, you're more likely to hit all 20 at 5 times their projected rate, right? It's just not going to happen. I mean, if you did the work on 3 of them and nothing came out, I think it's time to go back to the drawing board. Why would you continue with the rest of the 17, right? That's where the safety comes in, and you add in all the other elements of the price of the commodity as well as the reentry and the workover. That makes it a much, much, much safer bond-like investment with oil and gas returns. And then you throw this into the mix from a financial perspective, they're home runs.
Yeah, that's all. I mean, 100% agree. 100% on top of that and agree with what you're saying. Yeah. So that's what I'm saying. Like, that's why, again, I'm not saying that I'm partnering with Scott, but if you can, we're partnering with Scott on some really cool opportunities like this, taking policy loans to invest our own cash in deals like this. So if anybody doesn't have any other questions like this, we can start to move towards the end of the call. But again, this was a little bit different than usual, and I just want to try and present just great ideas, different thinking outside of the box. Again, Scott was mentioning the depreciation, the tax benefits. There's just a lot of really cool things that's involved in this different strategy. Doesn't have to be always the same thing. I just want to put you guys in contact with great people that
Here's another thing. You'll never get a landlord call at two in the morning. You're never gonna have to deal with a tenant. I mean, with this, you write a check and the rest is cash flow to you.
Yeah, 100%.
There's no doing
Hopefully
the
they're
actual.
triple net leases though. We're not dealing with tenants either though. But I don't disagree with that at all. 100%. Anybody else have anything else before we start to get moving? And once again, guys, this is recorded, so I'll upload this so you guys can rewatch and hear all, because it's a lot different than what we usually talk about. So there's a big learning curve. It took me months before I even understood what Scott was even talking about. I'm still not even, I feel like I'm not even halfway there. So if you guys don't have any other further thoughts or questions, I will send an email or Scott, if you're not opposed to this, I might just put your information on our school platform, which is where all of our members are warehoused and where we all kind of congregate. And if they have any questions or thoughts, and I can just send a connecting email, introduction email, and you guys can just take it from there and just be, you be
that's perfect.
I don't think
That's what we're here for. Yeah, we're more than happy to help with the the educational side of the investment.
So cool. All right. Anybody else have anything else? Final thoughts before we get moving tonight?
Thanks. I just appreciate the information. It's pretty exciting.
Awesome. Yeah.
Yeah. Well, thank you for having me, Nolan. I appreciate it.
Yeah, no, absolutely, Scott. I appreciate you making the time. I know it's the evening time with family. Like my kids just got home, so
my dog just got home
just like everybody else. Yeah, you saw that too. Yeah, so perfect. All right, well, I appreciate everybody making on tonight. I'll upload this thing this evening and tomorrow. And if anybody else has any thoughts or questions, get with us directly and we can make it happen. So much. Thanks so much, everyone.
Take it easy.
Have a good evening. Thank you.